Hi, welcome to the Market Alert for Thursday, the 22nd of September 2016. So we've got a situation where yesterday the market opened, lost 26 points as the market reversed, put in a sell signal, which then pulled this back with the market trading through the scalp on this buy. You can see it driving through to pull back the loss on the buy trade. If you actually traded these, I didn't bother at the time, I'll be perfectly honest with you, but that was a winning trade which would have pulled back the losses and some. Then we had the release of the Fed minute meeting and also rate decision, which of course we all know was unchanged, so these two signals are ignored. The market digested after half an hour or so, and then we have a buy signal that moves to the upside there, and then another one later on in the evening. So the Fed have decided to leave rates unchanged. This means we're still on the emergency policy from 2008, bar one measly 1/4% in December of last year, where they tried to, well, they did raise, but then of course the market fell apart. And also, again, it just goes to show how bad things are and how confused they are, that they can't even raise rates by 1/4%. What's interesting is this article. The Fed now sees only 3 rate hikes through to the end of 2017. Cut long run US GDP potential. They haven't got a clue. They absolutely haven't got a clue. And normally I wouldn't watch the press conference, but on this occasion I did, and it was absolutely gripping as Yellen struggled. And also I noticed that the questions that were asked by the journalist must have been given beforehand, because she was actually reading the reply as well, which just goes to show how rigged it all is now. You can't even ask a question without it first being vetted and then a reply actually written out. So if you want to have a look at that, have a look at Bloomberg's site and make your own judgment there, but that's what it looked like to me. Anyway, this is a contradiction. Anyway, you can't have 3 rate hikes and then cut long-term GDP potential either. So, if you think that the long-term GDP is going to drop, why are you increasing interest rates? This stuff isn't rocket science. It's very logical. If your GDP is going to go through the roof, then I can understand why you want to raise rates. But when you actually cut the long-term GDP, then you're going to find yourself in a situation where you've got 250 basis increase in interest rates. So aren't you going to cause a recession by doing that? You see, the problem is none of them know what to do anymore. And even when questioned about the labour market, she then switched to productivity and said, we really don't know about productivity because the labour market expansion has been so great that she's now struggling to see where the productivity is going to come from to keep the economy going. So that's why the forward forecast for GDP is dropped, but we're still going to go and increase interest rates because we all look like we're still in control and we know what we're doing, when they haven't got a flipping clue about what it is they're actually doing. So that's the news behind the move. And this is the daily chart move where you can see the market reversing there. Also, of course, the fact that the market was let off the hook, and it was let off the hook, as I've said before, it's not about data dependency anymore on whether the labour market is fully employed and all that nonsense. It's about market dependency, i.e. the stock market. It's about the Federal Reserve making sure they don't upset the financial markets and keep everything intact, so it gives the illusion that everything is fine. When questioned about this, she said that the Fed was apolitical, which I get, not a problem. But then she went on to say about during the meeting there was no politics mentioned and notes never mentioned and everything, as the notes will reveal on the memos will reveal 5 years down the line, because the Federal Reserve have the fortunate or in a fortunate position where they can actually not release or don't release any of the market minutes until 5 years hence. So great, isn't it? They can say what they want, do what they want, but knowing that the public and the markets will not get that information until 5 years down the line. I mean, you just couldn't make this stuff up. Talk about opaqueness. But there you go. Sorry, not opaqueness, not transparency. I mean, it's all smoke and mirrors behind the scenes. So this is good news for the market. You see the market moving higher there, heading back to 18,306, back above the 20-bar average as well. And really, it's just because they can continue to monetize the debt, and this is good for the stock market. So another reason why we saw the implied volatility move low, which we'll come to in just a second. Let's just have a quick look, see if there's any news out today. We've got Forbes speaking at 6 p.m. Let's have a look at a bit earlier than that, 2:30. 3 p.m. we've got existing home sales, and then Forbes speaking at 6 p.m. and Carney is speaking at 6 p.m. as well, so that should give the evening session a bit of a lift. But again, nobody believes what Carney has to say anymore either, frankly. I'll say a loss of credibility for all of them. Just before we look at the implied volatility, Deutsche Bank news. Deutsche Bank may ultimately need a state bailout. Well, that's going to be expensive given they've got 42 trillion in derivatives. So I'm glad I'm not going to be picking up the tab on that one if they do need it. Just let it go bust like they should have done with all the other banks in 2008. And again, you can see from the chart that prices after last week, when they wouldn't pay the 14 billion fine, you can see how the markets moved lower there. Watch the 10 euros per share level as I keep going on about. Implied volatility 1183. This dropped markedly, obviously because there's no risk to the downside all of a sudden because there's no rate increase, and you see this pullback in the chart here. Right, that's it for today. I will see you in tomorrow's. We'll report in if there's anything to report in about. So the market's going to digest what Yellen had to say or didn't say yesterday. So it could be a bit quietish, but it's just one of the effects of a live FOMC meeting. That's what happens generally the following day. Right, that's it. See you in the next one. Thanks for watching.